Hello, and welcome to today's Crane Shares webinar. Our third quarter China review, lines in the sand, and policy support. My name is Brendan Ahern. I am the Chief Investment Officer at Crane Shares Exchange Traded Funds. My colleague, Dr. Xiaolin Chen, our Head of International, and I are excited to host today's webinar. With the Shanghai and Shenzhen composite indices trading below the 1,300 and 1,900 levels respectively, we believe a line in the sand has been crossed for China's policymakers. There have been a marked increase in the tone and tenor of policymakers as new economic policies are being rolled out to support China's incremental economic recovery post the removal of zero COVID. Additionally, U.S.-China diplomatic relationships continues to improve with a Biden-Xi meeting just a few weeks away. Xiaolin and I are going to review China's third quarter market performance, the policy adjustments that have occurred just over the last several weeks, and most importantly, the potential economic meetings and events that are apt to be catalysts for investors in the weeks to come. So let's dive in. Please proactively ask questions during the webinar as we hope for a lively question and answer after the presentation. If you're viewing us on craneshares.com, please email us at info@craneshares.com. SEMA designations can receive 1 hour of continuing education credits by emailing us at ce@craneshares.com. For those of you not as familiar with Crane Shares, let me provide a quick overview of our firm. Crane Shares founder Jonathan Crane formed two core beliefs during his experience living and building a successful business in China. These two beliefs were the basis for founding Crane Shares over 10 years ago. The first was that while new China's sectors such as domestic consumption, internet, e-commerce, semiconductors, clean energy, and healthcare have become the new drivers of China's economic growth, these sectors are still under-allocated in global portfolios. The second founding thesis was the opening up of China's mainland equity markets, the second largest in the world, as well as China's onshore bond market, also the second largest in the world. That opening up would have a significant effect on investors' portfolios in the years to come as these markets are included into global indices. Most importantly, we endeavor to earn the trust of investors through our balanced, data-driven perspective on China's economy and capital markets. China's rise in market indices, along with its economy, will necessitate investors have a partner to navigate these developments. Crane Shares wants to earn that partnership role with you. We maintain a daily research blog that is available at www.chinalastnight.com, which we encourage you to subscribe to, as this free, informative website research blog allows you to keep abreast of developments as they occur in China's economy and capital markets on a daily basis. Crane Shares today, over 10.5 years after our founding, has a broad suite of US-listed exchange-traded products that provide investors exposure into our core beliefs on China's opening up, as well as our thematic growth series. We've also diversified our business into the other significant catalyst and opportunity in the next decade and years to come, which is climate investing. We've taken what we've listed in the US market and applied that to the UCITS market, with Xiaolin and our European colleagues continue to grow our suite of UCITS exchange-traded funds. All right, Xiaolin, let's take a quick look back at Q3.
Right. It's an interesting quarter. I think you and I discussed this. We included this heat map of a very colorful table here, really for the audience to know the data was really the broader indices versus some of our Crane shares ETF indices of their returns over a different period of time. We obviously chose the last 5 years, could be any period of time. A couple of key things we want to highlight here. One is you can see our ETF, given the nature is an emerging country, the themes, the trends is evolving, establishing, and capitalizing. So it tend to perform in a high beta fashion. That could be in the up market. You would up a lot more if everything is really picking up in growth, supportive policy, corporate start to deliver earnings results, focus on fundamentals, such as a year like a 2020. You could also have a year just be balanced on, our stance on performance. Obviously, it's not an indication of any recommendation whatsoever, but it's worthwhile noting in a year like a 2022 peak of topics, discussions, and topics around China and around the world, you could also have just a few months completely change the order of performance in ranking. We see a lot of issues we discuss around US and China, so on and so forth. Brandon and I will discuss later in the pages. But then when China starts to perform back on their own feet of delivering strong policies, you could have a KVAB in a few months' time totally, turn around with their performance, outperformed major indices across the board, such as 2022. Q3 is an interesting quarter. We see a similar kind of return of accommodating policy announced, stronger than anticipated data release, so on and so forth. That also led KVAB outperformed, for instance, S&P and broadly speaking, MSCI All Country World over 6%. We understand it's only a quarter. Our point is this is actually a strategic allocation. When the performance turns, it can be turned very quick, very sharp. Staying invested or have a leg invested is quite an important strategy. Brandon, I just pass it back to you.
Yeah, 100%. And yeah, I think that Q3 performance of our flagship strategy, KWEB, outperforming, providing positive returns in Q3, while many global indices struggled, is really an indication that many of the headwinds that have weighed on the space have either lessened or at a bare minimum have actually turned around, where they're actually no longer a headwind, potentially a tailwind. And I think certainly, if we looked back at what our conversations were like a year ago, we'd be talking about China's internet regulation, the Holding Foreign Companies Accountable Act, the potential delisting of Chinese listed ADRs. Obviously, China was still in zero COVID. Real estate was a multifaceted problem between distressed real estate developers and falling property prices. And certainly at the time, the geopolitical risk that the U.S. and China just quite simply at a political level were just not speaking to one another. And if we fast forward to today, many of these issues have improved very significantly. And I think that's something that showed up. We're starting to see that in the Q3 performance, that many of the reasons investors were hesitant to allocate to the space are improving. I would even argue less bad is a positive catalyst. And yes, not all of these issues have completely gone away. But again, if these are things that have pushed investors to the sidelines, I think there's some rationale for why investors should be coming back in. And I do think one of the items is this potential delisting risk was certainly a factor that for many professional investors, for many fiduciaries, it simply made the China ADRs uninvestable. How can you, as a fiduciary or as a professional investor, hold a stock if it could be delisted? You're certainly in the case of Crane shares, we've migrated many of our ADR positions to Hong Kong as a fiduciary. We want to protect our investors' assets. And we did see last December, after visiting Hong Kong, the PCAOB said the first round of auditor reviews, they passed. The PCAOB went back to Hong Kong. They have not opined on how the second round of audit reviews has gone. Imagine if we get a positive. Remember, the audit reviews are with the big four U.S. accounting firms. It's hard for us to imagine that they will fail. There could be fines, there'll be deficiencies, just as there were in the first round, but we do believe that they will be given a passing grade, and therefore the SEC should remove these stocks from a list that they maintain of securities that could be delisted. I think that is a significant headwind for many professional investors to come back into the space. And yes, things are improving, but I think that's something that we're watching for. Could come really at any time. We don't know exactly when that's going to occur, but it's certainly something that could happen at any moment. Moving on, I think one of the reasons going into 2023. We were positive. We were constructive on Chinese equities. Just on a relative and absolute basis, China's economy, the capital markets looked like things were going to be improving coming out of the zero COVID policy. And while that did play out, that rally did fade a little bit in the second quarter of this year. And I think that increasingly, almost shockingly, U.S. equities continue to outperform despite very high valuations, higher inflation. Many things went against U.S. equities, but we believe that this tide is turning and that many of the fundamentals in China, economically, on the corporate level, investors are going to make a pivot to this space. And I think, yes, we've had an incremental, a slow economic recovery, but it's very clear that the Chinese government is very aware of this situation. And I think, we're starting to see policy adjustments to support the economy taking place. And I know, Jalen, we're actually starting to see the potential trickle-down effect of some of these policy adjustments coming into some of the economic data already.
I would agree, Brendan, because we watch on the monthly data release on a frequent basis. Whenever it comes out, obviously, it's a little bit of a pickup domestically, and also some retrievement of, say, exports order coming to China. You unavoidably would have a little bit of a, take 2 steps forward and a bit of a step back in the whole economy to recover. It's understandable. It's such a big country, and also not only reopening, it's also rebalancing its economy, right? At the same time, reopening, rebound, and rebalancing all together. I think it's important to recognize what is actually happening underneath of the economy in China. Here are some data we have kept watching on them. GDP is one of them. I was in a conference not long ago in London. Some people argue it's 4.5% for this year. It's 5. It's what? In my opinion, it didn't really matter. You land your forecast on 4.5, 4.9, or whatever the number is. The news is the Chinese policymaker is doing whatever it takes to make the economy to recovery. With all the available liquidity, all the available toolkit they have in hand and implemented and to be implemented, I think achieving a 5% target for this year is almost not a question. That's in our view. Obviously, you do want to see certain things to pick up, for instance, credit. There's a lot of liquidity being injected to the economy. You want to see credit to pick up. And retail is, to us, the most important is China's probably 2 big goals. One is modernization. We want to see that modernization encourage people continue to urbanize, to go to city, continue to feel comfortable to contribute on the consumption side. So we do see positive pickup in September, retail sales 5.5%. August was 4.6%. It's all on the trajectory of going up. Industrial productions, you have a bit of a disadvantage of both holidays fall into 1 month. The national holidays and also the middle autumn holidays is all in 1 month, so you have a bit of a slower down. Fixed assets investments, I think now the liquidity become more liquidity become more available, the bond issuance we're going to touch base on later, that actually will help the fixed assets investments going forward. And on the next page, Brendan, we think it might be helpful for the audience to have a summary sheets, because we keep on going out to tell clients, listen, they have done massive measure to help the economy. But every time you probably feel, oh, they cut the risk again, they cut the risk again. So here is our summary page from March all the way to September this year, 6 months. You read it yourself, see how many times PBOC actually actioned on cutting the interest rates. Almost every month from March, if not April, Premier League came out. May, he met unicorns, meet the industry leaders, they create the jobs. June, July, August, they've been cutting rates. Cutting rates is a general term. The rates they cut at front end, make sure the liquidity is sufficient, there's no systemic risks. Middle and stay longer term rates is impacting mortgage, corporate borrowing. Those are definitely providing liquidity to the corporate to spend, mortgage rates to help the household to reduce their monthly mortgage payment, i.e. they have more money to feel comfortable in their bank account, feel more comfortable to spend. That's one of the tools they have been implementing. These measures are important. You will not have here you go, just free money, hundreds of $1 billion go and spend. They want to choose the path like this to be very targeted, very focused to provide liquidity to the market. And so is a policy to provide to the market. At the end of the day, if you go to the next page, China is an emerging country. Policy matters the most. So now they have made monetary, physical policy stay very accommodative. The other leg they could have done or they will do is corporate policy. What are the concrete other industrial policy, tax favorables, which sector will get that, which one get favorable projects, and also when the bond issued in Q4, when the money start to flow down to the systems, what projects should we carry? All those concrete policy indication should come out from all these meetings we listed on the page. I know still a bit of a long from October all the way to earlier first quarter of next year. Some may move slightly the date, so on and so forth. But here you go. This is your agenda. This is the policymaker, the central governments, the governors, the financial minister, everyone is meeting. You can see from October, November, early May, December, January, they have a busy agenda. What are they doing? They are reassuring the markets. We know your concern. That's very important. And we care about it. The last thing, the third most important is we're going to introduce accommodative policy to reassure the market that the economy will rebound. So I just pause there, Brendan.
Yeah, I think this is such an important slide, Jalen, just that, what's going to be happening, as these events, these economic policy meetings come out, the supportive measures that could be released following them. Certainly around Singles Day, obviously, huge event. We'll also have the Q3 earnings for many of the K-Web companies, second and third week of November. So I just think that, there's some positive things coming. And if we think about the media narrative, it's going to be hard to, I call it the nadering nabobs and negativity. We know some positive news is coming, and I think it's well overdue for investors to kind of relook at the space.
Mm-hmm.
One area, Jalen, that's definitely we've seen an improvement. I mean, obviously, on the corporate side, U.S. and China business people are getting along just fine. We've seen a whole host of European and U.S. executives visiting China. At the same time, it's only been really earlier this year that the diplomatic relationship has improved, where we finally see the U.S. and China government officials engaging one another. Clearly, the White House, the Biden administration, is looking to stabilize the relationship. And we've had a whole host of Secretary of State Anthony Blinken, Janet Yellen, the head of the U.S. Treasury Department, climate czar John Kerry, Henry Kissinger, U.S. Secretary of Commerce Gina Raimondo. We've seen a whole host of U.S. diplomats traveling to China more recently. Senate Majority Leader Chuck Schumer and California Governor Gavin Newsom, who both met with President Xi. I think the gravity of Schumer and Newsom meeting with President Lee should not be underestimated. And we're having, just yesterday morning, the White House said that a Biden-Xi meeting would take place at the APAC conference in just 2 weeks' time, the third week of November in San Francisco. So the China side's not confirmed that. So we'll curb our enthusiasm until we see that that meeting confirmed from the China side. But this fractured relationship that was under stress going into COVID clearly suffered due to a lack of communication, a lack of dialogue, clearly a very significant change. And I think one thing, Xiaolin, from spending some time with you and the team in Europe, was that I think one thing that might not be as familiar to some of those outside of the United States is understanding the power structure of the U.S. government, where the real power and prestige is with the White House. That Congress, yes, they have power. They can create laws, but even within Congress, the Senate, has a 6-year term. So the senators tend to be a little bit more balanced, and we can contrast that with members of the U.S. House who only have a 2-year term. And so when you see news coming out of Washington, D.C., you almost have to rank, where is it coming from? Because if it's coming from the House, there's not significant power there. Again, and that's what's really important. It's not at the we almost have to discount if members of the House in Congress are saying things. We have to discount it because there's hundreds of House members. The real power, where we need to put the gravitas, is on the White House, and it's very, very key to see the change that's taken place in terms of the tone and tenor of the Biden administration. Now, I know, Jelen, there are some more things coming that we want to take a look at. One of the questions that's come up more recently is around Taiwan. And I think earlier this year we did a great event with researcher from GavCal Research, where he went and visited Kinmen County. Now most of you are certainly aware that Taiwan sits about 100 miles off the coast of China. Very few people are aware that Kinmen County sits just 3 miles off of China. And if on the bottom right, this is using Google Maps, and this is about everything we do here at Crane Shares. You should be able to replicate that work on your own. And what you're seeing here on the bottom right is using Google Maps. You can see people Taiwanese live just 3 miles off the coast of China. And if the Western media narrative is that, they're about to roll in, isn't this the last place you would live? In fact, what you're seeing there, that track is actually where a school is located. If you have children, would you put them in danger? And just more recently, back in August, I had the opportunity to visit Taiwan, and I think the general consensus was, just leave us alone. We want to be just kind of left alone. We do great business with China. We do great business with the United States, with the West. Certainly, there's an important election coming up in January. But my general view was, people just wanted to be left alone, and they did not like a lot of the saber rattling. They did not want U.S. politicians visiting Taiwan because the Taiwanese people suffer some of the consequence. So again, take a look at Kinmen County. Use Google Maps. Thousands of people live there. I don't think you'd live there. And again, so take a look at that. Now, moving forward, Jalen, I know there's another comparison. Mm-hmm. Our brains are kind of wired to find easy solutions to complex problems. That can be Russia, Ukraine, China, Taiwan, but another one has been this comparison to Japan.
Yeah, I agree, Brendan. This topic comes up. I think this is it Japification? I get the word right. Comes up more often now, become a buzzword, I say. So we want to address that. We want to address that. Since you asked, we want to address that. We did some comparisons after look through ourselves, read other people's comments and feedbacks on it. So we put everything in one table to say why some of the people think that China is or looks like the lost decade of Japan. What are the arguments they put there together to say that's the case? And we just list some factual status between the two. One is Japan in 1990s, and then now currently China is at now. Obviously, GDP growth is in a very different trajectory. If you argue, well, China is the low, 5% now, 6% now, we don't disagree, okay? You wouldn't have that 10, 15, 12% GDP growth, the double digits growth anymore, because it has very fast speed forward its economy between 1990s all the way to 2010 to become the second largest economy in the world over 30 years of period of time. They have achieved that. Going forward, either nominal, very easily to understand, you will have the single digits return of a GDP. However, still 5% GDP they are targeted for the next decade so that they can achieve their national goal of modernize the society. We still think that 5% is much better, much long-term, more sustainable. This compared to Japan, which is only 1%. Property sector comes up a lot when people use the discussion or comparison saying the assets inflation, the Chinese property market is consolidating. It's just like Japan, this price is so high, so on and so forth. So we use a bit of a comparison to say, where is the property market valued as a percentage of their GDP? Japan back in 1990s, yes, they were at 560% of the GDP is actually property valued. So it is a dramatic, big, number. Where if you look at China, it's 260%. We don't think the property sector's consolidation in China happening now, it's still occurring now, is finished the consolidation phases yet, but it's actually on a good trajectory to be more positive to contribute to the GDP. So at the end of the day, this wouldn't be a strong argument to let us to believe this will lead China to the next decade. There are certain other arguments like stock valuation, very straightforward. China valuation is hugely now lower valuation compared to Japan's was such high valuation back then. But of course, that could also argue where the valuation will stand. So we do think when market turns to focus on fundamentals, this is when and where you pay more attention to these billions of dollars revenue, all these companies been generating quarter over quarter, that their valuation and price will adjust accordingly. So that's our stance on that. Currency, obviously, yen, if you remember in 1990s, it literally appreciated over 200%. Okay, where renminbi today is at a very stable range, is still market oriented. Intraday, you have a certain percentage allowing to trade them up and down, but the main currency moves in Chinese yuan now, in our opinion, is majority dominated by the interest rates differential from dollar and renminbi. Okay, onshore still easing, where in US and most of the developed market is tightening. So this is the main driver of the currency. No comparison, no direct direction correlated versus China and Japan. There are other issues like a demographic, long-term growth strategy, and population. I'll put those all together, which is true. Japan had 123 million people in 1990s. Until now, they still have 123 million people, give or take, still the same. After 20, 30 years, they still same demographic. There is a forecast to say China is at 1.4 billion people, where they would continue to be the 1.4 billion people in the next decade or 2 decades to go. I would put a huge question mark on there. Okay, China introduces a single child policy, one child policy in 1980s. They have heard, okay, this aging population issue. They have relaxed the one child policy, I think probably about 2-3 years ago. Then subsequently they introduced, you can have 2 children, you can have 3 if you want, and then now they start to subsidizing the family if you can have more children. Education is already free in China up until university. So they are doing everything they can to ease the pressure financially for the household to be able to more willing to have children. It does take time for this to be corrected or move to the positive, territory. It will be a lag effect, but I would put a big question mark on the number. So we wouldn't know, but I would think there's high chance that China can go back on the growth trajectory again in the coming years rather than stay there. But I also want to say the base case comparison is also very different, okay? China's urbanization rate today is at 65%, where they aim to achieve the 80, 90% like a developed market. Japan was 77. Even if China compared to Japan still have 12% urbanization to grow from the current level, that's give or take, okay, give or take 160, 170 million people. That's the entire, population of Japan. So long story short, there are similarities. We don't deny property markets consolidation, debt issues, and potentially people, population growth, young children birth rates, so on and so forth, does present some question mark, but we don't think at an alarming level to say this is identical to that. There's so much they can do, plus all the policies, all the economic growth directions that the Chinese policymaker has not used much of their dry powder whatsoever. If you look at the next page, we read all these economic policy announcements when it comes out in Chinese, in English. Both Brandon and I exchange our thoughts to try to confirm from the original source what is the Chinese policymaker is trying to focus. Very simple, two things. Modernize its society. This has been mentioned multiple times when Xi Jinping was re-elected as the Communist Party leader October last year. And also throughout this year, there's a lot of discussions of how to help the people at the poorer area to have better education, to have access, so on and so forth. All the goal is to urbanize the society. That urbanization would require China to continue its modernization, including moving people to city, including building more green infrastructure. That 1 trillion bond issuance is exactly designed to support project as such. Okay, that's their focus to continue to grow economically. And second is industrialization version 2.0. That is what we believe that China is focused on, two things. The industrialization, very clear, green transitioning. Okay, they have relied on heavy industry for a very long time. Now they realize that they actually can deliver very front and innovative technology to help them to achieve sustainable long-term growth, such as green technology, green energy. They are the world leader in EV productions. They bought the most, they sold the most, and they made the most. They will continue to lead that innovation, that progress in such. We also think that present a lot of investment opportunity. Carbon green transitioning is a global theme, globally unified, that doesn't really present much volatility with either geopolitical or domestic concerns. In other words, everyone is aimed to achieve the same goal for us to achieve the carbon goal. So this is really the other things that China wants to achieve. Modernize its society, achieve the industrialization version 2.0, continue to do innovation, technology, green transitioning, so on and so forth. That actually is where we'll put our money in. Obviously, they have the most is people. The modernization, urbanization would require a recovery from a consumption point of view. They did a lot of things to help households have more money to spend, but of course, we got to watch closely to see where the data and how they have been reacting. Perhaps, Brendan, do you want to share a few thoughts on that?
Yeah, I certainly think this idea of stability is such a key that it's such a key tenet for China, and that's been part of our rationale for why the narrative on if it's invading Taiwan would be unlikely because that would create instability. Certainly, a lot of economic instability. It's just incongruent. And I think that's also true around things like real estate. It's allowing a Lehman moment would be incongruent with the objective of economic, political stability in China. And I think speaking when our conversations with a lot of economists in China and strategists in China, they all point out the biggest central bank error ever was the U.S. Federal Reserve allowing Lehman Brothers to go bankrupt. And why? Why? Well, because it created an economic catastrophe, not only in the United States, but globally. And why would China allow a disorderly demise of a systematic risk like an Evergrande or a Country Garden? Certainly a restructuring, a debt restructuring, certainly, but the disorderly, highly unlikely. I think while some of the media headlines continue to be negative, we are seeing positives, and one of those is what we saw in Golden Week. That we saw that after 2 years of zero COVID policy, the Chinese were ready to get out and about, both domestically and certainly international travel is coming back slowly. It was more based around Asia. In Italy, we experienced a little bit of Chinese tourists making their way to Milan. But certainly domestic consumption trends did show that post the removal of zero COVID, there's a strong desire to get out and about. Certainly that was verified by a lot of the gaming data out of Macau. Yes, there's 100% scar tissue from zero COVID. That the consequence is not a flipping a switch. But it's coming back slowly, incrementally, and I think this domestic consumption story will continue to improve, and that makes us constructive on another event coming up, which is Singles Day. That we're only a week away from the Super Bowl of shopping, by far the largest e-commerce event globally. Already, Alibaba and their rival JD.com are talking about the early pre-sales have been going well. But certainly, we'll have just in a week's time an event that's going to be, hard to deny that the Chinese consumer is back. Are they completely back to 2019 levels? Well, we'll find out, but it's more of incrementally, we do see a uptick coming. And we think that this will have a benefit for e-commerce players, Alibaba, certainly, their arch rival JD, as well as Pinduoduo. And, I think that's something that will flow through to the balance sheets of these companies in the when they report Q4. Certainly, as I mentioned, the Q3 data is only a few weeks away. But I think this is something that we know many of these headwinds that have weighed in investor sentiment have been very much detached from the fundamentals of the companies, Jalen. And I know that's something that, for us as bottom-up, observers of the fundamental data, that's something we've seen within the K-Web companies.
I would just echo your Singles Days. I know I was talking to my mom. She's literally getting her shopping cart ready.
I got to get ready myself. I tend to do some shopping as well.
I know things she like, then she's really just getting ready. When the sale starts, she's like, buy. She's by the way, she's already 74 now, but she's absolutely loving this. I just want to say, it was fascinating to see, and also the data obviously available is saying even, I think the data 2021 was over 3 billion parcels, 3 billion, you heard it right, okay, get delivered during, this period of time. So it's fascinating to see that, absolutely. We'd love to see that continue to happen. One way to show, obviously, people after pandemic, after the strict lockdown, they are now finding a way to treat themselves, either buy something nice or they can even book a holiday, okay, during this period of time with discounts. When we say shopping, I just want to tell the audience, it's not just say, buy a mug, buy a book, buy something. No, they can buy holidays, packages, they can buy cars online. Yeah. They can buy TV. I mean, I found it hard to buy a car online, but I think now people is very used to it. It's everything online, big or small, regardless what, some are really beyond what we, at least in Western world, could have think of. So I hope to see some broader pickup. We shall review that after the Singles Day. But this is directly important to our thesis, our cases of, for instance, for K-Web. it is a representation to say when this 1.4 billion people in China, they spend 100 RMB. Okay, when that 100 RMB start to travel in the systems, wherever that lands, investors like you and I investing in this fund should benefit from that transaction happening in China, period. So this is our design. Obviously, we have been monitor the fund return on this page, for instance, is the blue line. Obviously get distracted when the regulation introduced that safely assume is reconfirmed multiple times is behind us by the Chinese policymaker, and they kept their promises, really now become very accommodative. But that being said, the top 10 companies in KWEB still produce quarter-over-quarter strong earnings, where the fund is still just catching up with the performance. We have about a quarter lag data here, but if we look at last quarter, you know, the year was it year over year, you have all these companies still produce revenues 9+%. So I just want to reiterate that fundamentals of the company is actually very healthy. Is investors chose to be led by macro factors to drive on performance than fundamentals. Then you would almost ask yourself a question: when investors will start to realizing or value the fundamentals as their key driver? I think when the macro environment stays very clear, very accommodative, very friendly to investors, then investors turn to look and say, where is the value? Where shall I invest? We believe we are at the point, given all the policy announcements that Brendan and I shared. So that gap between the performance and the earnings, we do still firmly believe should close and will close. That's where we stand on that. And if you go to the next page, this is really where we see the valuations. And, you know, we obviously realizing, you know, the earnings, it takes time to pick up, and so is the price, but then it does present it a very attractive entry points. If you look historically, Brendan, we talked to a lot of technical analysis analysts as well on this. Do you have any more colors to share than me just going through the numbers?
Yeah, I mean, I think certainly we're seeing a little bit of a I think you have a bottoming process in terms of the economy. Yep. We've also seen this bottoming process take place from a stock price movement that we are not, we're well off the all-time lows in KWEB.
Yeah.
And I think that just shows that you're starting to see investors kind of come back into the space, partly driven, I think, by the attractive valuations on a relative, but also from a historical perspective, that there's just we definitely believe there's an opportunity that some of these non-fundamental factors that have really weighed on the space as they dissipate, investors are going to get pulled back into these, and we're arguably seeing that. And I think, on the next slide, Jalen, it's this disconnect between the fundamentals of the company has gotten to a point where it's almost laughable, in my opinion, that you can buy all 31 companies in KWEB with Amazon's market cap. That's despite Amazon generates less revenue, less net income, less earnings per share, has less cash. And so if you think about what the market is saying, that Amazon has more purchasing power potential than 1.4 billion people. I disagree. And, the market, there's the famous quote, can be a voting machine in the short run. But I think in the long run, it is a weighing machine. And I think there's a real opportunity in the space. And another factor that's weighed on the net is the strength of the US dollar. I think it's a little bit of a almost sleeper headwind, but the great outperformance of US stocks over the last several years has been aided and abetted by a strong US dollar. And that does weigh on non-US equities, including the companies in KWEB, that, if the renminbi has deappreciated versus the dollar, those corporate values are worth less in dollar terms. But I think after, if we don't know exactly what Fed policy will be, But arguably, you had a very dovish Powell press conference yesterday. And whether or not the Fed is completely done hiking or not, that could arguably take a little bit of the wind out of the strong dollar. And I think that would be a good tailwind for risk assets, including K-Web. And it's interesting to see, even back in July, we had this bounce in, this nice rebound in K-Web, which was accompanied by a weak dollar. So this is something for investors to watch, but I think there's a strong argument that as we look out over the next year, that if the Fed is done, the potential for Fed cuts at some point, potentially by the end of next year, there's a strong rationale, and certainly macro events like what's unfortunately happening, playing out in the Middle East, has made the dollar a little bit of a safe haven, and hopefully that situations like that are resolved, and you could see some of that safe haven status kind of reverse. So definitely something to watch with the dollar. Now I know, Jelen, many of the things that we've spoken have been really geared to our flagship fund, K-Web, but arguably a lot of these factors, they've affected other areas of growth in China. When investors want to buy China, I kind of call it the good stuff, right? You want the K-Web companies because they're the transmission engines for domestic consumption in China. But as a company, we see great opportunities in other growth sectors, and a lot of domestic Chinese foreign investors, they don't buy banks or energy stocks. They want these growth parts of China, and some of these factors have weighed on that, despite some strong fundamentals similar to what we're seeing in K-Web.
I'd agree, Brendan. And then, a lot of things we discuss here today, of course, to try to tell you where our policy stands, what is China is focusing on, and look at these slowly, gradually, but is rebounding in consumer power, Golden Week, people are traveling, and where we see really the huge disconnect between the returns and the fundamentals. And the other things we want to obviously say to the investor is, stay a little bit medium term to long term to understand what China is trying to achieve, which China actually have already proved their track record in such. And this 1 trillion, Brandon, remember I messaged you, 1 trillion is coming. They're not talking about trillions, 1 trillion bound, and they literally say infrastructure, but they don't meant the old infrastructure. It's a green infrastructure. So on and so forth. It brings some questions of where the liquidity will get deployed to the economy. And then this is the other part that Brendan and I shared in the past, is the green part of China, the green part. Last year in February, they did first ever in history a carbon neutral Winter Olympics. It was really for them to showcase, hey, we can deliver a large scale of carbon neutral project and achieve the whole national to become carbon neutral. We also keep very close eye on carbon neutral does require heavy investments, period. Okay, and China, thanks to their the earlier 2000 accumulated a lot of advantage in financially, so they do have the money to spend to support such projects, which they have showed that just in 2022 they spent $546 billion just in 1 year to support energy transition investments, because that is really the 80% of the CO2 emission the country is emitting every year. So they say, let's deal with how much we emit, let's invest in those areas. That's compared to, I live in London, that's compared to EU, that we plan or hope to spend, give or take dollar euro, more or less the par, $578 billion over 6 years. Okay, so that's just a comparison to show who actually have the investments and determined and really aim to achieve that. If you go to the next page, a couple of things really comes up. Say, okay, when China's dealing with the emission part, try to emit less, use a new way to your livings, new energy to use for your house, for your building, so on and so forth. Really, China has really produced the most is renewable energy. Okay, this is really at the front and center to make sure the energy self-efficiency and also green energy transitioning is their forecast. So if you look at the blue bar, it's really early stages. They were really just start to thinking about it 2000. Fast forward to last year, you already see, I think that should be the little green bar, that's 2000. China already shows the capable of exceeding where Europe is be able to achieve in the renewable energy as overall the capacity produced by the country. And now it's projected to be more than the rest of the world altogether to produce, by 2027. So it just shows the investments, the results, things are progressing dramatically. So we do think there's a huge investment opportunity presented there. We have solutions like cars, like KGRN, which we launched very recently to play the green transitioning, green technology in such areas. The other area we want to mention or we want to touch base on manage the emission side is the next page, electrical vehicle and future mobility. It is very important to understand that in China, they have the most middle class, 700 million people, probably. That's their targeted group to say, please help to manage the emission down. Not every family has a car, but they will be. Now they are encouraged to say, what if you don't buy a petrol car, diesel car, whatsoever, you buy an electrical vehicle car, we give you relatively cheaper price, we give you less road tax, this and that, would you buy one? And a lot of cities, like tier 3 cities, tier 4 cities today, the public transportation buses and things like that, they use a lot of the public transportation still is electrical buses. Okay, so they are really progressing very quickly in the society to adopt into this practice. You would argue, right, they only sold 1.4 million. Would that be progression from here? I would think yes. The answer is yes, given they have encouraged people to do such, they have heavy investments, and that actually helped a lot of incentive for Chinese companies to focus on design and deliver a smart electrical vehicle. They call them smart. I had the pleasure to visit NIO, which is one of the largest representable electrical vehicle house in China. Visited their show house in Rotterdam with my colleagues and some of our key clients there. I have to say I was pleasantly surprised how the interior design look like. It gives you the absolutely pleasure of the luxury design altogether. It has a little robot at the front called Know Me, okay, Know Me, kind of Know Me, and you can tell Know Me to do anything you like. One thing I like the most is to ask Know Me to turn on the massage in my seats, which is very pleasant. I sit there for a very long time to have my massage. So I just say, you would be pleasantly surprised how good the quality is, how smart the car they have designed. Now the EV players in China are extensively coming out of China to internationalize their presence globally. I hope that brings more pleasant choices for customers and consumers around the globe. And be able to present a strategy along those lines will be very important. If we go to the next page, Brandon will probably want to conclude. I think I'll just say a few things and I'll leave it to you to conclude is, I know there's a lot of noise, a lot of headline news, a lot of things you read on every day about China. Stay focused, stay long-term can be painful because short-term performance is right in front of your eyes. But you got to understand this is a country, have the most people, 1.4 billion people. You got to benefit from that consumer power period. And particularly now the government let the society to focus on modernization. That modernization would unavoidably to create more wealth for the society. More people move to city, become more wealthier, require and consume more. So that's our core thesis. It's not a tactical, it's not a symmetrical trade. That's core thesis of accessing China. And obviously that other satellites opportunity presented, we just discussed electrical vehicle, renewable energy, and they are pursuing full speed ahead with investments, with companies, with corporates are delivering remarkable products for global investors. We all think, these are your really long-term investment opportunities, we shall say.
Yeah, I couldn't agree. Very well said, Xiaolin. I think it's kind of interesting to see earlier this week, California Governor Gavin Newsom went to Shenzhen, and they had videos of him driving a BYD electric vehicle. And just overnight, actually, in today's China last night, we spoke about the October sales numbers, and BYD, kind of remarkable. So this is you call it new energy vehicle. So this is not just EV, it's also hybrid. But BYD in the month of October sold over 300,000 NEVs. Certainly a whole host of companies also, Li Auto went over 40,000 electric vehicles sold. NIO, let me look here. NIO did 16,000. XPeng did 20,000 for the first time. More than 20,000 electric vehicles sold in the month of October. So yeah, certainly clearly a space that I think is really ripe for ETF usage, that there's a lot more to electric vehicles than simply Tesla. And certainly we didn't even touch on some of the Chinese battery makers like CATL. Certainly, again, please submit any questions to info@craneshares.com, or otherwise use the Q&A button. Certainly keeping abreast of what's happening in China, we offer a whole range of resources. The China Last Night research blog is just a quick overview of what's happening in China, but certainly for US or European investors, we provide just on CraneShares website. So you can sign up for our research as well. And then the other major trend over the next decade and century, in addition to China, we believe will be the climate, that we've pioneered carbon credit allowance futures investing. And to keep abreast and learn more about this new asset class, please take a look at climatemarketnow.com. So again, please submit any questions to Xiaolin and I. And yeah, I'm really, certainly it's this year's not been what we thought going into it. Just coming out of zero COVID, China's economy and outlook in terms of inflation, money supply growth, much stronger than the U.S. But potentially we have a pivot coming up in the next quarter, the next year, and I think we're really well positioned, and certainly some real opportunities for investors. Just take advantage of these lower entry points, right? It's a good time to be a buyer, and certainly as a investor in the space, I'm certainly looking forward to hopefully a rebound going forward. Okay, let's we can go in and take a look at some of the questions.
Brendan, someone asked about the China's carbon allowance program. It's worth noting it wasn't, I think it was was it last year, 2022, July, or I was thinking 2021. I could get the year wrong, but the month is correct, July. From the year, I think it's 2021, July, that they established their ETS, emission trading systems, just like California, UA, UK, they have established their system in 2021, July. Then they started to do the trial, or they call them pilots program, to invite certain province. So China structure is central, then province and cities. So they invited certain province to be on the trial, on the pilot program. They have the key states like Shenyang, Changchun, Harbin is Heilongjiang, so all the provinces on it, because they are heavy industrial cities and provinces. At the moment, I felt they have probably 8 provinces, and the 9th one is trial on the pilot program that covers probably about 2,300 power plants altogether. So it's a huge coverage, but then they can still continue to work on quite a few more. It comes to the 2-year mark. If I get the 2021 year correct, come to the 2-year mark. I felt now at the moment they give the free allowance. Obviously they set a level and still treat the allowance as free, but then they are absolutely ready to move to the next stage, which I touched on the carbon world. So stage 1 is, are you in or not? And they were, right? 2020, they signed, 2016, they signed the Paris Agreement. 2020, President Xi Jinping announced the 2030 and 60 goal. Now they have the trading system. They're really on the staging one. The staging two now is to manage down the emission as much as they can. Stage three would be, you know what, we're going to, am I just give me some down? So I said down, and then that's smart ideas like down.
Yeah.
So the stage three would be, we're going to price you. Okay, just like in UK, in Europe, and in US, how you treat in your carbon credit market, they are not far from that. To achieve that, I do think it will take probably another 12 to 18 months before they feel they have included all the impacted sectors, provinces, cities in it. Then it's ready for trading.
Yep. Yeah. Certainly, whenever they do policy adjustments, it's not the proverbial pulling the Band-Aid. It's done incrementally. You have a hypothesis, so you test it on a small scale, and if it turns out that it's a null hypothesis, you go back to the drawing board. But if it's successful, then you expand that test. And I think you're seeing that approach taken in terms of China's onshore carbon credit allowance program. It's started small, but it'll inevitably grow. One question we got from Simon is just more of good question here, just talking about this incremental policy support we've seen from China. I think that's, if we contrast the Chinese government's response with with many Western, certainly here in the US, you had helicopter money, modern monetary theory, and certainly there's been a real consequence to that policy, high deficit, as well as high inflation. And I think we can contrast that with what we've seen from China, saying, the economy it's a cycle, and the economy will come back. We're dealing with this scar tissue, this overhang of zero COVID on consumption trends, but things are incrementally improving, albeit slowly, maybe not as fast as we would like, but it's undeniable that it is incrementally trajectory improving. And therefore the government isn't necessarily willing to do a 2009 style policy bazooka that created a lot of debt in China, certainly had a very big effect on commodity prices and infrastructure in China. But you're seeing a little bit more of targeted exposure, but I think consistent policy adjustments to support the economy. And so I think we just have to be maybe a little patient in understanding that things are improving, and I think that will play out on the domestic consumption side. It's just playing out slowly. Certainly, there has been this headwind of falling real estate prices, scar tissue, but over time those will heal. Just maybe have to be a little bit patient. But I think it's probably the most important slide we have, Jalen, is all the things that are going to be coming over the next several weeks alone, and what sort of policies are going to be coming out of these meetings. I think there's reasons to be positive on the space.
Yeah, plus potential Xi and Biden meet. I got this question, I couldn't help myself to jump on it. Brendan is from our Italian investor asking if China do modernization, how can Italy help China in this? Remember our roadshow in Milan in September that we had the pleasure that you did interview the Alibaba's general manager, and during one of the conversation, and I made a lot of notes, and one of them I remembered such strongly, and this probably answers your question, is when he started to set up Alibaba in Europe, he was instrumental in setting up Alibaba outside of China, particularly in Europe. Obviously, he being Italian, he's very driven and instrumental in bring Italian brands onto Alibaba's platform, not Alibaba as a marketplace. So he's working on that. And I remember one example he told me, or told the whole audience, was how he's trying to convince Maserati to do their car sales on Alibaba's
Yeah.
platform. I think the car maker was like, you must be joking. Okay, we are a high-end car. People will have to come to the showroom to see the car, try the car, feel the car before they will even decide if they come back again, or not even talking about buy the car on spot. So he tried to convince them. I remember he was saying, and then say, listen, just give me 100 car, let me try it. Finally, he convinced the people, and then they put the 100 Maserati car on Alibaba's platform to say, okay, let's launch. And then they launched. Obviously, I can't interact with the audience now live, but I would just say, give a guess. How long does it take Alibaba to sell that 100 car on that platform? You give a guess, okay? I can't talk to you, but keep it to yourself. I'm going to reveal the results. I think it'll be good if it's 1 week. That's already remarkable. They literally did it in 18 seconds. 1 week. So I just want to share that to say that when Chinese consumer power returns, it's beneficial to all of us. And as a result, the Alibaba general manager literally bring 4,000 to close to 5,000 names from Europe to onboard it on Alibaba's platform. So you're already helping, and they're already helping you. So I think it's a mutual benefit for that. I couldn't help myself with the 18-second story. Sorry, Brandon.
Yeah, I thought, I thought it was obviously cars is very important to Italy's economy, but so is agriculture, and there's a big effort from Alibaba, Italy to get Italian agriculture, if it's wine and a lot of products for newborn babies to get that from Italy to China, and that was that was one thing I had observed landing in Milan was these two ginormous Air China cargo planes up at the airport in Malpensa, and clearly there is a strong economic ties there. Maybe on Alibaba, Xiaolin, that's something that I think Alibaba is going through a process of telling investors how inexpensive they believe their stock is, that they're literally going to split themselves into 6 different companies that they'll maintain a holding company that will maintain ownership in the underlying stakes, but we are getting closer that their logistics arm Know has filed for a Hong Kong IPO. We don't know the exact listing date, but they're certainly starting down that path. And beginning of September, the company started operating independent of one another with their own management companies. So I think what Alibaba is telling us is just they believe fundamentally that their stock is so inexpensive that the companies, since they went public, they've generated 10 times the revenue from when they went public, and the stock is below its IPO price. Just doesn't make any sense unless you understand these non-fundamental factors that have weighed on it. So I think this is they are telling us something, and Alibaba and certainly other companies in the space buying back stock very dramatically, if it's Tencent, Baidu, Alibaba, and others. But certainly also you're seeing that from Chinese policymakers that they believe the stock market is cheap, that their sovereign wealth fund went in and bought not only a number of Chinese stocks, they actually went in and bought a Chinese ETF. And so they're these different investor types are telling us that they think it's a good entry point today.
I would agree. I think Huijin like a 5.8, 5.9 trillion. I think in assets under management, when they started buying, this clearly signal saying the government not only providing the liquidity, also providing stability to the financial market. Yep. It would be good to monitor them if they will continue, and the sizing, so on and so forth. Do you want to time space? Go ahead, sorry, Brendan.
Oh, I was just going to say, if you a few questions around receiving the presentation, so please just email us either at info@craneshares.com or your Crane Shares contacts, and we'll certainly happy to get you the presentation as quickly as possible, as well as a replay will be available in short order as well. So sorry to cut you off there, Xiaolin.
No. It's great to remind them that we'll make it available to you. I was just looking at the shadow banking question from the audience. What about shadow banking? I think two things. China learned shadow banking the hard way. When they deleveraged 2015, 2016, Brandon, it was a very painful process. Remember how much they have to do and how painful they have to deleverage. So they remember that very heavily. So they would try to avoid going through the same path again after they have gone through the heavily deleveraging. The other thing is it was because of the borrowing cost is such high channel to go through back then, and liquidity was more scarcity that you can get hold of. And then if you want to grow your business, you rather go borrow even more expensively through different vehicles, so on and so forth. Today, the situation is very different. The liquidity is very sufficient in the systems. The interest rate is on the lower end. They have cut many, many times of the rates. We discussed that during the presentation. And the fact that the central government issued this 1 trillion renminbi bond instead of local government is trying to help the local government to avoid the debt issue. That means the 1 trillion would be on the central government banks' balance sheets rather than the local government. They give it to them. The central government actually liable for the payments of interest and all this on that. So they are dealing with that. It's definitely in their near-term memory. I sincerely think that would not pick up into an alarming level, given all the macro conditions set today in China.
Yeah, I think it's that emphasis on stability is that many Western central banks react to crises, and the China central bank and policymakers, due to this emphasis on stability, proactively try to put fires out before they start. Yeah. And I think that's true with what we saw with shadow banking. It's we've seen some things around media narrative around ghost cities, and even the real estate. Your real estate. Many of the problems of the distressed real estate developers was actually driven by the Chinese government trying to rein them in, and so I think it's key to when it's something I've learned over the last decade and a half is just when you see some of these headlines around China from the media's. One, always remember the last recession in China was in 1993. The media narrative is China's about to go off an economic cliff every other week, it feels like. But then reality is they haven't had a recession since 1993. And then the other thing is to remember is this emphasis on stability, and think about looking at events through the prism of this stability objective. Does it create stability or instability? And I think that allows us to maybe trust, or one of the questions around understanding the government's intentions. Does it create stability or instability? And you'd say, okay, a lot of the things that the media narrative is saying about China, maybe through that facet, that lens, it's not in their own self-interest. Well, Xiaolin, I know we've gone a little bit over, as is the case when you have a deck with all this great material. But certainly, again, for those who'd like to receive the deck, just please email us at info@craneshares.com or reach out to your CraneShares contact. If you wake up tomorrow or over the weekend, again, please reach out to us. We're always available. But yeah, certainly very much a great presentation, a lot of great information, and certainly a lot of good things coming. So please be sure to sign up for the appropriate research link as you see fit. And until next time, Xiaolin, I know we've got some fun things coming up on the horizon, some positive catalysts. Let's certainly hope equity markets start to prevail.
Definitely, Brendan.
All right, thank you. Have a good day.